please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. You got about a 5 or 6 odd point cut, absolutely flat. It's been that way from the morning and nothing really happening. Aashish Somaiyaa is Managing Director and CEO at Motilal Oswal Asset Management Company. He's joining us right now to discuss fundamentals of the market. Ashish, thanks very much. Good morning.
Morning.
You know, to begin with, only as an aside, you've been spending a fair bit of time on social media, you know, in a way, fending off attacks about performance, Motilal's performance, you know, coverage on some certain stocks. I guess it's part of a cycle. I remember seeing this in earlier market dips as well, where you see large correction in mid caps, etc., and people go after you know, brokers and others who own the stocks or covered the stocks. I mean, but broadly, and I'm talking about a couple of them, 1%, PC Jewelers, etc. Just a quick word on that, Aashish, before we get on with our daily conversation on markets.
You know, so of course, social media presents us a huge opportunity to at least you know, communicate what we think, what our views are. And if you really ask me, I think, you know, since we have portfolios where there are pretty much more like 20 stocks in these portfolios, our portfolios are indeed widely followed. And if there are questions asked to me, I take it as a compliment, because, you know, bulk of the portfolios in the industry, each and every portfolio pretty much owns the whole market. And, you know, I don't know how can you ask someone a question on a stock which is stock number maybe 71, 81 or 91 in their portfolio. So we, of course, we had a particular position, and, you know, every once in 5 years, every once in 10 years, there is something out there which clearly comes as a unexpected, you know, development. It's par for the course. I think it's part of the profession. But I think as far as performance is concerned, last year, if you really ask me, has been a bit of a challenge, and I think it's not been widely spoken about or well covered actually. You know, 2017 was a unique year, because if you take the calendar year 2017, Nifty was up by 28-29%. I think the mid-cap index was up by 48-49%, and small cap was up by something like some 57%. And then instead of calendar 2017, if you extend it by 15 days on both sides, the peak of Jan 2018 or the bottom of Demon in December 2016, then these numbers get hugely exaggerated. Now, you know, we are stock pickers, and when the market gains this huge momentum, high beta, you know, deep value, contrarian kind of rally, then it becomes very difficult for people like us who are basically owning 15-20 stocks, bottom up, high conviction. So if you ask me, you know, these kind of huge rallies are very difficult for stock pickers, whereas 2018 has been a different year. And, you know, while the discussion has steered in a particular direction, I mean, we never owned PC Jewelers at all in any of our portfolios, so no connection out there. But 2018, in fact, has been a better year, because, you know, while the market has corrected, these are the times when we are able to recover the alpha. And hopefully our clients are looking for a, you know, return over a 3-year period, rather than worrying about one individual position or worrying about just the last 6 months or any one calendar year. So I think things are looking great from here on. It's you know, these kind of markets are better for stock pickers than what we saw in 2017.
Okay. Aashish, hi. Thanks very much for joining in. It's definitely become much more difficult to pick those stocks, because you don't know whether they come with the risk of, you know, an auditor leaving or maybe some other corporate governance issues these days. So how are you filtering your mid-cap selection now? Have you learned from the examples which have taken place in the past couple of months in mid-cap pharmaceuticals and the Manpasands of the world? Have you strengthened your process, or what kind of due diligence are you undertaking?
So, you know, in terms of the process, the process has always been out there in the open. I think we are, anybody who is in the equity markets as a professional, whether they accept it or not, the reality is that you are dealing with uncertain outcomes at all points in time, you know. We do research, we do our homework, but generally we are dealing in a profession where the outcomes are never in our control. And whatever wealth creation efforts we make for our clients, the outcomes are over 5 years, over 7 years, over 10 years. And, you know, the proof of the pudding is only going to come much later. Hence, if you see what we have always been stressing on, in fact, we are one of the few guys who puts our investing philosophy and our style out there in the open. And I think that's why we invite a lot more attention probably. So our screeners are pretty much in place. I think we generally don't own cyclicals or commodities. We typically try to own secular companies and hold them for say 5 to 7 year kind of time frames. Our average holding period actually is more than 5 years when it comes to any of our portfolios. And the screeners are pretty much there on return on equity, secularity of earnings growth, leverage ratios, volatility of the earnings growth. So it's pretty much laid out there. Learnings are clearly there. If you really ask me, I think there are certain times when markets give you signals. There are certain times when there is certain things which you miss out. And maybe you need to clearly delve deeper. The process is all pretty much in place. Process doesn't change. I think maybe the severity of application is something which has to continuously be beefed up.
Aashish, can you talk about a specific position in some detail? I mean, just checking. If you can, then we can.
That would be a challenge for me, honestly speaking.
Okay, no problem. Fair enough. You were talking about this only trying to own secular stories. So let's talk about here and now. One big turnaround. I mean, the beginning of 2018 was IT. Then it spread to pharma. I mean, the pharmaceutical index is up 16% over the last 12, 13 trading sessions. Many, on the opposite side, right? Many believe that the decline is actually, I mean, the change for worse in the pharmaceutical sector is actually structural. It was not a cyclical one-time dip that we saw, and things are now going to be all right. Nobody's disputing that the opportunity is there, growth is there, but it's taken a turn for the worse and for good, and it's going to stay on that road. Do you agree with that?
So, clearly, whenever something takes a big knock, for example, even some of these businesses were expected to be moated, and in the last couple of years, precisely those moats have been taking a knocking or taken a hit. So pharma is something, I mean, we typically always had, if you see our funds, while we did have some of the big generic players maybe 2-3 years back, but in recent times all our funds have had more like the domestic bottom-up Indian pharma kind of companies. Having said that, coming to your question, there is obviously been this wave of, governments trying to control healthcare costs, whether it's the US or whether it's India. And I think eventually these are things not cyclical in the sense of the word cyclical, but these are, things where even the policies, they change over a period of time. The reason is that if you don't allow pharmaceutical companies to make money, clearly it is going to impact, future investment and R&D. And it's not like these things are static in nature, that, if you come out with a particular drug and, the government allows you to earn for 2 years and then cuts your earning for the next 10 years. I mean, even the viruses and the bacteria mutate, and people need to keep going, keep getting into research on an ongoing basis. So I don't think it is perpetually possible for governments to keep knocking down prices and hurt the pharmaceutical players to an extent that they don't want to really invest, and the future plans get into a jeopardy. So there will obviously be, these things swing both ways. And yes, there have been pricing pressures. Yes, there have been compliance pressures. Why do you think so many of these approvals are coming thick and fast? Because obviously somewhere some views probably have changed.
Okay. All right, Aashish, a pleasure talking to you. Thanks very much for joining in and speaking with us. So that's the view coming in from Motilal AMC. Just want to point out for the Nifty, 10,736 is where we're at. 1%, for example, is seeing follow-on buying today. So that stock is up around 5% Numbers will come out on the 27th of June. Some negative news on Hotel Leela. It's defaulted on interest payment of around 2.1 crores to LIC. You can see the stock reacting down 4% now, extending losses at this point. Take a break. But up next, we're going to continue tracking the IDBI Bank story of a possibility of LIC being interested in picking up additional stake in the bank. Mr. SP Tulsian will join in. Welcome back. Well, staying with the story where sources have indicated that LIC is in discussion with the government to pick up stake in IDBI Bank. Mr. SP Tulsian of sptulsian.com joins in on the show with his view on this. Mr. Tulsian, hi. Thanks very much for joining in. So if you could just start by giving us a brief of what you think about the news.
See, Ekta, I think this news seemed to be what you call analyzed in the background of the LIC angle, and I don't think that there is any point in taking a call that government wants to get rid of the IDBI bank because they have not been able to see any kind of improvement in spite of the fund having infused of about 12,500 crore in FY18, while the present market cap is at about 25,000 crore, with government sitting on 81% stake. But if I first take a call on the from LIC point of view, let me add here that LIC is definitely seen to be a keen institution which is keen to foray into the banking, because if you recall about 18 months back when the banking license were all issued by the Reserve Bank of, now it is available on tap, but at that time LIC had indicated that they are interested in coming out with a bank, full-fledged LIC bank. If you go by the Axis Bank, in which the promoter stake is at about 28%, 50% of that stake, closer to about 14%, is held by LIC Bank, which is again valued at about 20,000 crore. Of their 14% stake I am referring to. Hypothetically, if I say that government wants to get rid of the IDBI bank, I don't think that there is any point in taking a call that 40-45% stake will be given to IDBI, given to LIC in IDBI bank, in which LIC is already holding 11% stake. Because what LIC will do in that case? Can they be just as a joint promoter and remain in the passive mode and not with the active participation? So if government is really serious, maybe if I just take a broader holistic view of the LIC, I think that LIC is very much capable to run a bank. If you really see their performance of LIC Housing Finance, I'm not talking about the growth and all that, but LIC Housing Finance has been a profitable company. The LIC is the promoter holding 40% stake. The company has been reasonably doing quite well. So allow LIC to start a full-fledged bank. Maybe hypothetically, if I say that let the government transfer their entire 80% stake, I'm not taking the regulatory aspects here at this stage, whether the RBI will allow that. RBI can put a condition of bringing down this stake to maybe 30%, 40% as per the rules prevailing. So if the government wants to exit, give it full-fledged. Let LIC exit from Axis Bank, because Axis Bank again is seen to be having many suitors for acquiring it. Axis Bank is also seen the similar fate what we have been seeing of many other PSU banks or maybe many other larger private sector banks. So if LIC is able to monetize 20,000 crore stake in Axis Bank, put that entire amount of 20,000 crore in IDBI Bank, become a full-fledged promoter with maybe 80% stake with the regulator permission, that is RBI, that what will be the road ahead and how they will be asking the LIC to bring down their stake. If all these things happens, then it will really be seen quite good. But you just can't take an isolated move where government wants to come out with the monetization because they have not been able to induct any private sector party or any strategic investor, which we have been hearing all along in IDBI Bank. Because if you really see, the loan book is very low, maybe sub 2 lakh crore, highest GNPA, highest net NPA, and the things are seen worsening every day in spite of the IDBI Bank seen reducing their ratio of corporate to retail. Because in FY18 also, if you see, they have improved their retail portion by about 500 basis points. So I think this needs to be taken along with 2-3 other background and areas in which LIC can operate, which I have stated here.
Fair enough. I mean, which one of them is basically exit Axis Bank, you're saying? So it's not as bad an idea as it prima facie sounds. But this would most likely be seen, Mr. Tulsi, and I mean, and you've written about it about 2 years ago as well. Essentially, I mean, if this were to happen, the government using LIC as a piggy bank. I mean, you described the financials for IDBI Bank, and the fact that there isn't very much private sector interest apparently at this stage. So, sort of parking this with LIC, where there are millions of policyholders. I mean, does it even make sense?
Prashant, I don't know whether there is a private sector interest to be seen, being seen in IDBI Bank, number one. Number two, you are right. If you are shading your part stake, which we have been hearing that maybe about 40% out of 81% which the government is holding, then it can be termed as dumping the bank with the LIC, where the stake of millions of policyholders are involved. But that's what in fact I've started my analysis, that LIC is seen capable possible. In fact, if you really see the situation going forward in the asset management or maybe the financial services, there are ample scope of the housing finance company, NBFC, private sector bank. What we have seen in case of IDFC Bank. IDFC have hived off IDFC Bank. They have not been able to grow the IDFC Bank, so they've tied up with Capital First. Capital First is getting merged into IDFC Bank to expand, or maybe to show the growth, to achieve the growth, because there is tremendous potential seen existing. So allow LIC to run as a full-fledged promoter of a bank, because all along they have either seen as a passive investor or seen to be joint promoter, with the example which are given of Axis Bank, where they are holding 14-15% stake, sub 15%, which is within the limit permitted by the regulators. So allow LIC is capable of, because LIC have demonstrated the kind of performance in the life insurance business, and they've shown the performance in case of the housing finance as well. So that's what I say, that allow that, but let's not play with the money of the policy holders also, because you cannot keep on increasing your exposure. Probably government is worried that they've already infused 13,000 crore in FY18. Maybe FY19 is seen coming, and they may have to infuse further 10,000 crore. So they cannot keep on pumping money. They have to put an end to somewhere, and rightly so they are looking to induct a partner which they may not have been able to find out. So they may have floated this idea of putting 50% stake with LIC, which is wrong. So maybe LIC also, it will be very good move on part of LIC, that I am monetizing my 20,000 crore in Axis Bank. I am not increasing my exposure in the banking financial services. That same money I am using for turning around the IDBI Bank of my own, for which they have the resources and they have the bandwidth.
Okay. All right, Mr. Tulsian, thank you very much for giving us all of that perspective. So that is Mr. SP Tulsian talking about IDBI Bank. We need to take a break now with the news that even the rupee has in fact appreciated. 67.77 is where it's at. Take a break, but more on equities as well as on the rupee once we're back. Stay tuned.